Bob, you're here on set with us. I'll kick it off with you. What'd you make of this, what we might call a dovish hike today? It seems like there's something for everyone.
Yeah, I think, Powell delivered what he was intending to do, was to give that dovish hike, give some indication that they may be near an end to their tightening, but also leave the door open for possibly more tightening if the data comes in and forces his hand to keep going. And I think that's the key thing that probably disappointed the market. I think many people in the market were hoping that this was one and done, and they didn't quite get that, and we see it in the stock response in the 3 o'clock hour.
All right, David, want to get your thoughts on this too. Conditional pause, data dependency, where we're seeing the Fed actually be data dependent. How do you see it?
Yeah, I think all of those, Morgan. I think it was very much as expected. I don't think the market is surprised by this one bit. We were up, 20 or 30 points in the S&P. We ended up down 20 or 30 points in the S&P. I think it's a pretty low volatility day for a Fed day, and a few ticks here or there on the 2-year note and 10-year note. And he delivered what he wanted to deliver, which is, hey, we've done 500 bips. It's a lot. We're going to watch for a little while. And honestly, we're pretty happy. We've still got a 3.5% unemployment rate after those 500 bips. Inflation's coming down. Inflation expectations, 5-year, and the break-evens and the 1-year break-evens are all kind of where we want them. And we just got to take our tough medicine and slow things down and lose a few jobs and get this inflation lower, and we can be back to normal. But, he's not declaring victory anytime soon, and I think his message was the same. It was, we're here to be vigilant against inflation, and we're actually pretty happy with how the job market has performed through all of this tightening.
All right, I do want to mention Qualcomm earnings are out. We are going through them now. The stock is down initially about 4% on those, but we'll continue to go through those numbers and bring them to you in just a moment. Bob, so this was a unanimous hike from the Fed. Assuming the labor market stays somewhat strong with tomorrow's report, even if slowing, how much tightening of credit conditions is going to be necessary for the Fed to be able to say, okay, we're ready to pause now?
I think the big problem that the Fed is running into is that this isn't a credit-driven expansion or strength in the economy. It's an income-driven expansion and demand. And the result of that is, even though the banks may continue to tighten credit to some extent, actually, they tightened credit a little bit in the first quarter, a fair amount in the first quarter, and the economy continued to be relatively strong when you think about nominal final sales. And so I think what they're betting on is that credit can bring this economy down, and they're probably missing just how strong that income driver is of this economy to keep things going. And so that's why, as long as that unemployment rate stays at 3.5%, as long as we see those wages continue to grow at relatively elevated pace, 5 to 7%, you're going to continue to see more demand, more strength in the economy than the Fed wants to achieve its inflation mandate.